Welcome to the Deep Dive, where we cut through the information deluge to give you clarity and insight. In a world just, well, awash with data, understanding the real forces shaping our economy and your investments can feel like a full-time job.
It really can. It's a constant stream, isn't it?
Absolutely.
Wow.
But it doesn't have to be overwhelming.
And that's precisely our mission today, to provide you with maybe a shortcut to being truly well-informed without getting bogged down in every single headline. We're taking a deep dive into the latest pulse of the U.S. stock market.
Right. We'll focus on the week that just wrapped up, ending August 8, 2025.
Exactly. And then we'll pivot a bit and look ahead to what promises to be a really pivotal week. Lots of economic data, some key corporate reports coming up.
Our goal here is to extract the most important nuggets of knowledge, helping you understand not just what happened, but more importantly, why it matters and what it could mean for, how you see the market.
Yeah. What's the takeaway? We're going to dissect the surprising resilience, I think you'd call it, of the tech sector.
And navigate the complexities of these new tariffs. That's a big one.
Huge. We'll also peek behind the curtain of some major corporate earnings, some big winners, some big losers last week.
And highlight the critical economic indicators that could really sway the Federal Reserve's next moves. So get ready for some surprising facts and insights, hopefully giving you a new perspective on the market's inner workings.
Okay, let's unpack this. Looking back at the week ending August 8th, U.S. equity markets, well, they finished with remarkably strong gains.
Yeah, it was the third winning week in the last four, right?
That's right, a pretty solid run. And this rally represented quite a rebound, especially considering the slide we saw the prior week.
So what was behind that rebound?
It was largely driven by what analysts often call buy-the-dip activity. Basically, investors stepped in after that pullback.
Seeing it as a chance to get in cheaper.
Exactly. They seemingly viewed it as a temporary discount, a buying opportunity.
And when we dive into those headline numbers, the NASDAQ composite was undeniably the star performer, wasn't it?
Oh, absolutely. It surged an impressive 3.9%, closed at a fresh record high to 21,450.02.
Wow. That's its best weekly performance since, what, late June?
That's right. And it was powerfully propelled by the technology sector. That sector hit consecutive record highs on both Thursday and Friday. Just real strengths there.
The S&P 500 also showed some pretty robust gains.
It did. Climbed 2.4%, closing at 6,389.45, which, as you said earlier, basically reclaimed its prior week's losses.
And finished just shy of its own all-time high, the one it set back in late July, so very close.
Very close indeed. And the broader market participated too, though maybe with less explosive gains. The Dow Jones Industrial Average added a respectable 1.3%.
Okay, ended the week at 44,175.61.
And it wasn't just the large-cap titans pushing things higher. The Russell 2000 Index, which tracks smaller companies, that also saw a solid rise, up 2.4% as well.
Closing at 2,218.42. So on the surface, you might look at that and think, okay, broad-based, healthy rally.
You might. But here's where it gets particularly interesting, because beneath those encouraging headline numbers, we saw a pretty significant underlying divergence.
Ah, okay, so not everything moving in lockstep.
Not at all. This advance was heavily characterized by large-cap growth stocks. They significantly outperformed their value counterparts.
And this is for the second week in a row.
Second week running, yeah. We saw growth stocks gain a robust 3.2% compared to just 1.4% for value stocks.
That's a big gap.
It is. And this isn't just some academic distinction, It points to a concentrated, sort of top-heavy nature of the current rally.
Meaning it's not as strong or as widely spread across different types of companies as those index numbers might suggest.
Precisely. It suggests the foundation might be narrower than you'd ideally like to see.
And that leads us to some other signals, maybe more technical ones.
Yeah, it does. There were some critical technical signals that I think warrant caution, even amidst those record highs on the NASDAQ.
Like what?
Well, while the NASDAQ was forging new records, the S&P 500 actually displayed what technicians call a bearish engulfing candle on Thursday.
Okay, break that down for us. What does bearish engulfing actually mean?
Sure. So what happened was the index, the S&P 500, it gapped up at the open to a new all-time intraday high, 6,427. That signals really strong momentum initially, right?
Right, looks like it's going to be a great day.
But then it reversed course sharply. It closed way down near the low point of the trading day. And that day's entire price range, from high to low, completely engulfed or covered the trading range of the previous 5 sessions.
So a big upswing followed by an even bigger downswing all in one day, erasing the progress of the whole prior week's range.
Essentially, yes. And this specific pattern, this bearish engulfing candle, can often signal a potential near-term shift in the trend. It makes overcoming that 6,427 high a really key test for the market bulls going forward.
It's almost like the market poked its head up, saw the new view, and then immediately got scared and pulled back hard.
Yeah. That's a good way to put it. It's a cautionary signal from the charts, basically saying, hold on a second here.
So that's one technical warning sign. Were there others pointing to this narrowness you mentioned?
Yes, absolutely. We also saw declining market breadth. This really reinforces those concerns about narrow leadership.
And market breadth is basically how many stocks are participating in the move.
Exactly. A key way to measure it is the percentage of S&P 500 members trading above their 200-day moving average. That's a long-term trend indicator for individual stocks.
Okay, so what happened with that metric?
Well, during the week, despite the indexes moving higher, that percentage actually declined. It went from 58.0% down to 56.9%.
Wait, so the index is going up, hitting records almost, but fewer stocks are actually in a long-term uptrend.
Precisely. It suggests that the rally may be less robust than the index levels imply. Fewer stocks are broadly participating.
It's like the generals are charging way ahead, but the broader army isn't really keeping pace, is it?
The generals and army analogy is perfect. It really captures the situation.
So what does history tell us about market rallies driven by such narrow leadership? Is this time different, or does this increase the risk of a pullback?
Well, history generally offers a cautionary tale here. Periods of extremely narrow market leadership, where, just a handful of mega-cap stocks are doing all the heavy lifting for the index gains.
Like the Magnificent Seven we hear so much about.
Exactly like them. Those periods have often preceded times of broader market consolidation or even sometimes corrections. It suggests a potential lack of underlying strength across the board.
So it's like the foundation isn't as solid.
Exactly. Now look, every market cycle is unique, you can't say for sure. But the risk here is that if those leading generals, the big tech names, if they stumble for any reason...
And there's not enough strength elsewhere to hold the market up.
Right. The rest of the market doesn't have enough broad-based momentum to pick up the slack. It makes the entire index potentially more vulnerable to sharper corrections than if the rally were more, let's say, democratically spread across different sectors and company sizes.
Okay, that makes sense. A potential fragility there. Now, let's shift gears a bit and talk about the narrative. What were the key stories or forces driving these market movements last week?
It was a really interesting mix. You had this complex interplay of macroeconomic policy, specifically trade policy, corporate strategy reacting to that policy, and underpinning it all, monetary policy expectations about the Fed.
Let's start with the trade policy. A central theme seemed to be the market's, well, almost nonchalant reaction to escalating trade tensions, specifically these new broad tariffs from the Trump administration.
That's right. We saw new reciprocal tariffs imposed on dozens of countries. There was a hefty 39% duty on goods from Switzerland, for example, that took effect on Thursday.
And the really big one seemed to be the semiconductor tariff.
Yes, a particularly significant announcement was a new, rather striking 100% tariff on imported semiconductors. That's a massive increase, clearly designed to try and reshape global supply chains.
But despite these pretty major developments, the market just shrugged.
Largely, yes. Analysts observed that investors seem to be becoming, quote, numb to tariff headlines, which does raise that important question. Why the muted reaction?
These kinds of policies usually inject a lot of uncertainty and potential cost increases.
It's almost like tariff fatigue, maybe. Or is there more to it?
I think there's definitely more to it. This muted reaction can be explained, at least in large part, by a really crucial detail buried within the tariff policy itself.
Which was?
A strategic exemption, an out, if you will. It was specifically for companies that commit to manufacturing chips in the United States.
Ah, so a carrot alongside the stick.
Precisely. This provision wasn't just a minor detail. It created a direct pathway for certain companies to actually turn what looks like a major macroeconomic risk into a potential competitive advantage.
And one company jumped on that immediately, right?
Apple. They moved incredibly fast. CEO Tim Cook announced a huge commitment, a $100 billion investment in U.S. production.
$100 billion. That's
Yeah.
massive, even for Apple. It's a staggering number. And crucially, that move secured the iPhone maker's exemption from those new 100% semiconductor tariffs.
So they essentially sidestepped the whole issue with this investment pledge.
Exactly. And the market saw this immediately as a major strategic victory for Apple. Their stocks surged over 4% just on Friday, and an incredible 13% over a 3-day span around that announcement.
Wow. And that didn't just lift Apple, did it?
No, it provided a powerful lift to the entire market, especially the tech sector. It really underscored how corporate alignment, or maybe strategic adaptation to government industrial policy, can create significant shareholder value.
That's fascinating. But is this kind of move, this $100 billion investment, something only a giant like Apple can pull off? Or could this policy actually help smaller, maybe more agile domestic manufacturers?
That's a really good question, and it's probably a bit of both. I mean, for a company of Apple's scale, $100 billion is a massive commitment, but they have the capital reserves, they have the supply chain leverage, the market power to actually execute something like that.
Smaller players might struggle to pivot that quickly or invest that heavily.
They almost certainly would. However, the policy does create this incentive structure that, at least in theory, could encourage more domestic manufacturing across the board, not just from the giants.
So what are the broader implications here? If companies are aligning strategy so closely with government policy, does this signal a bigger shift away from just chasing global efficiency?
I think it might. It points towards a potential shift, maybe even a significant one, in the architecture of global supply chains. For decades, the mantra was always efficiency, find the lowest cost, which often led to production being spread all over the globe.
Right, optimized for cost above all else.
Exactly. But now, factors like geopolitical stability, national security concerns driven by government policies like these tariffs and exemptions, are pushing for more localized production, or at least production in allied countries, sometimes called friendshoring.
Which might mean higher costs, at least initially.
Potentially, yes. It introduces new complexities, maybe higher costs in the short term. But the argument is that it also brings greater supply chain resilience and aligns better with national strategic interests. It's a really fascinating evolution in how businesses have to think about where and how they operate.
Okay, so that's the policy angle. But this policy-driven boost, especially for Apple, it landed on top of what was already a pretty strong foundation, right? Particularly in tech earnings.
Absolutely. This catalyst layered right on top of what was fundamentally a very strong earnings season for the technology sector overall. Especially those magnificent 7 mega-cap stocks we mentioned earlier: Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, NVIDIA.
What were the numbers looking like for them?
The forecasts were for them to report average Q2 earnings growth of around 25.7%.
25.7%. Okay, how does that compare to the rest of the market?
Significantly stronger. The expected earnings growth for the remaining 493 companies in the S&P 500 was just 6.3%.
Wow, that's a stark difference. 25.7% versus 6.3%. That really highlights that concentration, that narrow leadership we were talking about earlier, doesn't it?
It absolutely does. It shows just how much of the market's overall earnings growth is currently coming from this small group of tech giants.
And within tech, the enthusiasm for artificial intelligence, for AI, that remained a huge factor.
An incredibly potent force. You saw it clearly with companies like Palantir, the data analysis firm. They posted a nearly 50% year-over-year revenue increase. Just stunning growth.
50%. That's enormous.
It is. And they dramatically raised their 2025 forecasts as well.
Right.
And this wasn't just seen as good news for Palantir itself. It boosted sentiment across the entire AI ecosystem.
Reinforcing the idea that AI isn't just hype.
Exactly. It fueled the narrative that AI is a truly transformative technology, driving real, tangible revenue growth and operational efficiencies for the companies that can leverage it effectively. The market is clearly rewarding those who can show concrete results from AI.
So we have underlying tech strength, we have the AI excitement, we have Apple's strategic move on tariffs. It's a powerful combination. But was there a bigger, maybe more psychological force supporting the market, like the Federal Reserve?
Oh, absolutely. You can't underestimate the Fed's role here. The perception of a dovish Federal Reserve acted as a crucial psychological backstop for the entire market.
And this goes back to the jobs report from the week before.
Primarily, yes. The week began with sentiment still heavily shaped by that weaker-than-expected U.S. employment report from the prior week. That report dramatically boosted bets on the Fed cutting interest rates in September.
Because weaker jobs data suggests the economy is slowing, giving the Fed more reason to cut.
Precisely. When economic data suggests a slowdown, the market often interprets it as the Fed having more room, or maybe even a mandate, to ease monetary policy to support growth.
And did we hear anything from Fed officials during the week to support that view?
We did. There was some dovish commentary from various Fed officials throughout the week that reinforced this view. It wasn't one specific speech, but the overall tone seemed to lean towards being patient, maybe leaning towards easing.
So where did that leave market expectations for a rate cut?
By the end of the week, market implied odds based on futures trading for a 25 basis point cut at the September FOMC meeting.
Yeah.
They had risen to a remarkable 90%.
90% probability of a cut in September. That's almost priced in as a certainty.
It's incredibly high conviction. And this belief, this conviction that the Fed stands ready to support the economy, provided a really crucial anchor. It allowed investors to look past some of those negative headlines we talked about, like the new tariffs, or even other mixed economic data points, like a weaker than expected ISM services report that came out.
It's almost like the market is saying, okay, there might be some bumps in the road, but it's okay because we know the Fed has our back.
That's a very common interpretation, yes. The Fed put, as it's often called.
But, given some of those mixed signals, the strong tech earnings, but maybe slowing elsewhere, the tariff uncertainty, is there a risk that the market is too reliant on this Fed put? What happens if that 90% chance of a rate cut doesn't actually happen? Or what if inflation picks up again?
That is a critical question, and it points directly to a significant vulnerability in the current market narrative. The market's high conviction in a September cut, bordering on certainty, like you said, creates a scenario where any deviation from that expectation could trigger a sharp negative reaction.
So if the upcoming data doesn't support a cut, or if the Fed pushes back?
Exactly. If inflation data comes in harder than anticipated next week, for instance, or if the Fed, for whatever reason, signals they aren't ready to cut just yet, the market could experience a very rapid and potentially painful repricing of assets.
Because so much optimism is built on that rate cut expectation.
Precisely. This Fed put, the implicit belief that the Fed will step in to prevent a major market downturn, has historically been a powerful force, absolutely. But it can also lead to complacency among investors. It makes the market highly susceptible to what economists sometimes call data dependency shocks.
Meaning one single economic report could dramatically shift sentiment and valuations.
Potentially, yes. If the data strongly contradicts the prevailing narrative, the market might have to adjust very quickly.
Okay, let's switch focus now to how different sectors performed and what was happening in the commodity markets last week. The market action showed pretty clear leadership from sectors benefiting from these narratives we've been discussing.
Unsurprisingly, technology was the best performing sector. Given everything we've said about earnings, AI, and Apple, that makes sense. It gained 3.37%.
But what else did well? You mentioned basic materials earlier.
Yes, interestingly, basic materials also performed very strongly, rising 3.56% for the week, even slightly better than tech.
Why would basic materials do so well? That includes things like mining, chemicals, construction stuff, right?
It does. Strong performance there often suggests optimism about global economic growth. Or, perhaps in this specific context, maybe there's a belief that the new tariffs and the push for reshoring could actually benefit domestic producers of raw materials needed for manufacturing here.
Okay, a potential beneficiary of that policy shift. What about financials?
The financial sector also performed well. You saw bellwethers like Bank of America and MasterCard posting solid gains. They likely benefited from the overall positive market sentiment and maybe also from the slight steepening of the yield curve we saw.
But not all sectors joined the party. Energy was the worst performer.
It was, yes. Energy fell 0.89% as oil prices took a tumble. This is a sector that's been quite volatile recently, often swinging based on global demand forecasts and geopolitical events.
And healthcare was also a notable laggard.
It was, declining 0.61% for the week, which is interesting because healthcare is often seen as a more defensive sector, with typically more stable earnings. Its underperformance might reflect ongoing policy uncertainty or maybe concerns about rising costs within the sector.
This brings us to the commodity markets themselves, where we saw a really significant divergence that seems to reflect some of the underlying concerns.
Absolutely. On one hand, the price of U.S. crude oil fell quite sharply, more than 5% for the week. It was trading below $64 per barrel on Friday.
Which is pretty low compared to recently.
It is. It's the lowest level in over 2 months, and a steep drop from around $75 a barrel back in mid-June. This kind of decline often signals concerns about a potential global economic slowdown, which would reduce energy demand, or perhaps an anticipation of increased oil supply.
So oil prices suggesting some economic pessimism. But what about gold?
Gold was the complete opposite story. It experienced a powerful rally. This is really indicative of a classic flight to safety. Investors often flock to gold amidst geopolitical uncertainty or when they're worried about inflation eroding the purchasing power of currencies.
And gold hit a record high.
Briefly, yes. Gold futures surged to a record high of $3,500 per ounce on Friday, before settling just slightly lower, around $3,460.
Wow, $3,500. How does that compare to the start of the year?
It marks a really substantial gain. Gold was trading around $2,600 at the start of 2025, so that's a huge move up, highlighting a significant and sustained flow of money into the precious metal as a hedge.
So, oil down sharply, gold up sharply. That definitely sounds like a classic signal of market uncertainty and a move towards perceived safety, doesn't it? Suggests that even with the equity indexes doing well, there's this undercurrent of caution.
I think that's a very fair reading of it, yes.
What about the bond market? Did Treasury yields reflect this uncertainty, or were they more aligned with the equity market's optimism?
The bond market was a bit more nuanced. U.S. Treasury yields actually rose modestly over the week, reversing some of the decline they had the week before following that weak jobs report.
Okay, so yields went up slightly. What was the 10-year Treasury yield at?
The yield on the benchmark 10-year Treasury note finished the week around 4.28%. That was up from 4.21% the previous week.
Why did yields rise if there's all this talk about rate cuts and maybe some economic worry signaled by oil and gold?
Well, part of the reason seems to be related to the Treasury auctions held during the week. They were apparently poorly received.
Meaning not enough buyers showed up, or they demanded higher interest rates?
Essentially, yes. Weaker than expected demand for government debt at these auctions. This can signal a couple of things. Either investors are demanding higher yields to compensate for perceived risks, like inflation or more government borrowing, or perhaps there's just less appetite for bonds at those prevailing rates.
So the bond market wasn't fully buying into the immediate rate cut narrative, maybe. A bit of a tug of war there.
It suggests a bit of a tug of war, yes. Bond investors are weighing various signals, the potential for rate cuts, inflation risks, government supply, and sometimes they react a bit differently than equity investors who might be more focused on growth in earnings momentum.
Okay, so that covers the big picture market movements and the underlying currents. But let's zoom in now on something truly fascinating that seemed to define last week's trading at the individual stock level. These extreme reactions to corporate earnings reports.
Yes, this was incredibly striking. The week's trading established a really crystal clear market paradigm, almost a rule book for how stocks were treated post-earnings.
And that rule was?
Backward-looking results, meaning what a company did last quarter, how they actually performed, were clearly secondary. What mattered most, by far, was forward-looking guidance, what they expect to do in the future.
So past performance was almost irrelevant if the future outlook wasn't perfect.
That's essentially how it played out. Companies that not only beat expectations on their Q2 results, but also, crucially, raised their outlook for future quarters were handsomely rewarded. Their stocks often surged.
But on the flip side,
companies that signaled any kind of future weakness, maybe slower growth, maybe margin pressure, maybe competitive threats, even if they had solid current results, even if they beat Q2 estimates, they were ruthlessly punished.
Ruthlessly punished. It sounds brutal.
It was. We saw some absolutely devastating single-day drops. It was an incredibly instructive lesson in what the market truly cares about right now, which is future growth above all else.
It's almost like dating someone where their past achievements don't matter at all. It's purely about where they see themselves going in the next 3 months. If you aren't constantly demonstrating future potential, you're out.
Huh. That's a wonderfully vivid analogy, and honestly, not far off the mark for how the market behaved. This intense focus on the future really speaks to the market's core function as a discounting mechanism. It's constantly trying to price in what's next, not dwell on what's already happened.
Trying to predict future cash flows, future growth.
Exactly. And so companies that delivered not just good results, but a strong story about future growth, driven by narratives like technological innovation, operational excellence, clear growth runways, they saw their stocks soar.
Okay, let's talk about some of those high flyers, the ones rewarded for their future vision. Guardant Health was a huge winner, wasn't it?
An incredible week for Guardant Health, GH. Shares of the precision oncology company gained, get this, 30.93% for the week.
Wow, nearly a third of its value added in 1 week. What was the catalyst?
A stellar Q2 earnings report, certainly. Their revenue came in at $232.1 million, which was a 31% jump year over year. That comfortably beat analyst estimates, which were around $211 million.
Okay, strong revenue beat. What about profit?
Even their adjusted loss per share was significantly narrower than expected, -$0.44 versus estimates closer to -$0.72. So, better on both the top and bottom line.
But was that the main driver? Or was it the guidance?
It was absolutely guidance. The
Okay.
key takeaway, the real rocket fuel for the stock, was their decision to raise their full-year 2025 revenue guidance. They bumped it up to a range of $915 million to $925 million.
And how did that compare to what analysts were expecting?
It was well above the consensus forecast, which stood around $885 million, so a significant raise. This confident outlook, which they said was driven by accelerating growth in both their core cancer testing business and their newer screening products, just signaled really strong, sustainable momentum to investors.
Okay, clear beat and raise, big stock move. Who else? Palantir was another one.
Palantir Technologies, PLTR, yes. The AI-focused data analytics firm saw its stock gain an impressive 21.19%.
Also a huge move. What ignited their rally?
It was a record-breaking earnings report. Palantir delivered its first-ever billion-dollar quarter. Q2 revenue soared 48% year-over-year to just over $1 billion. That absolutely crushed estimates.
48% growth. That's phenomenal. Earnings, too.
Adjusted earnings per share came in at $1.16, also beating the consensus. And the company was very explicit about the driver.
Yeah.
They called it an astonishing impact of AI leverage. They highlighted their U.S. commercial revenue skyrocketing up 93%. And U.S. government revenue grew 53%, just massive growth figures attributed directly to AI adoption.
And wasn't there a contract win as well?
Yes, alongside the earnings, they announced a major new 10-year contract with the U.S. Army. So you had these powerful results, a big contract win, and they boosted their full-year guidance.
The trifecta.
Pretty much. It propelled the stock to new highs, even though some analysts were already pointing out its extremely high valuation multiples. It's just a clear testament to the market's immense appetite for verifiable AI-driven growth right now.
And we saw similar patterns elsewhere too, right? IDEXX Labs.
IDEXX Laboratories, IDXX, the animal health equipment maker, gained 22.87%. Same story. Stocks surged after they reported Q2 earnings and revenue that beat estimates and then, crucially, raised their full-year guidance. They cited strong execution, customer gains, new products, signaling sustainable momentum.
And RingCentral, RNG.
RingCentral rebounded strongly, up 21.72%. That seemed to be driven by news of new AI partnerships and product launches, again illustrating the market's enthusiasm for anything related to forward-looking tech growth, especially AI.
Okay, so a clear pattern. Beat on results, raise guidance, get rewarded handsomely. But the contrast with how the market reacted to perceived weakness is just as telling, isn't it?
Oh, absolutely. Equally severe, if not more so. It really highlights the market's unforgiving nature right now when future growth prospects are questioned, even slightly.
And it wasn't just about missing estimates, was it?
No, stocks were punished for any sign of decelerating growth, any hint of rising competitive pressure, or any negative developments in their future growth pipelines, like we saw with some biotech news. This pressure was felt across different sectors too, not just tech.
Let's talk about the trade desk, TTD. That was just brutal.
Brutal is the right word. Shares of the ad tech company plummeted a staggering 37.01% for the week.
And most of that was on Friday, right?
Yes, an absolutely devastating 38.6% drop on Friday alone. That was its worst single-day drop on record.
And the incredible thing is, they actually beat revenue expectations for Q2, didn't they?
They did. That's what makes it so striking. The company reported Q2 revenue that was actually better than analysts expected.
So why the historic plunge?
It was driven entirely by two forward-looking concerns. First, their guidance for the next quarter, Q3. Their revenue forecast of at least $717 million implied year-over-year growth of about 14%.
Okay, 14% growth still sounds pretty good.
It does, in isolation, but it represented a significant deceleration from the 19% growth they just posted in Q2. The market hates deceleration, especially in high-growth tech stocks.
So slowing growth was one factor. What was the other?
Competition. Analysts grew increasingly worried about rising competition from what are called walled gardens in the advertising space. Think Google, Facebook, and particularly Amazon. Amazon's AMZN growing demand-side advertising platform is seen as a direct and growing threat to the trade desk's independent platform.
So slowing growth plus increasing competition fears.
That combination prompted several high-profile analyst downgrades, and the floodgates just opened on the stock. It's a harsh reminder that if a company is priced for perfection or very high growth, even a slight perceived stumble in the future narrative can trigger a dramatic reevaluation by the market.
Absolutely brutal. Who else got hit hard?
Cogent Communications, CCOI, the internet service provider, their stock fell 32.17%.
What went wrong there?
The trigger was their Q2 report. Their loss per share came in at again at $1.21, which was significantly wider than the consensus estimate, which was somewhere around numbers 93, somewhere to 93 to 99 cents. So a big miss on the bottom line.
And revenue.
Revenue also slightly missed forecasts, and maybe more worryingly, it represented a sequential decline from the previous quarter. So revenue actually went down quarter over quarter.
That's not a good sign for a communications provider.
No. And these results highlighted a worsening cash burn situation for the company, alongside a pretty substantial debt load. This combination really raised investor concerns about its financial stability and its ability to fund future operations or growth, prompting that sharp negative reaction.
Even cybersecurity, usually a hot area, saw some pain. Fortinet.
Fortinet, FTNT, yes. A major cybersecurity firm saw a 23.59% drop for the week. And again, this was despite reporting solid Q2 results.
So why the drop?
Simply put, its outlook, its forward guidance, failed to impress investors. It wasn't bad, necessarily, but it wasn't strong enough to meet the high expectations baked into the stock price. Another clear example of the market's ruthless focus on the future.
But maybe the most illustrative case of this sensitivity to future prospects came from the biotech sector with Vertex Pharmaceuticals.
Yes, Vertex, VRTX, was really notable. This biotech giant stock dropped a staggering 20.73%.
And what made this one particularly interesting?
It was because the plunge occurred despite the company reporting a solid 12% year-over-year revenue increase in Q2 for its existing drugs, mainly its cystic fibrosis franchise. And they even reiterated their full-year guidance for that core business.
So the current business is doing well, guidance is unchanged. Why on earth did it fall over 20%?
It was triggered entirely by two pieces of bad news concerning their pipeline of future drugs, which were announced at the same time as the earnings.
Setbacks in drug development.
Exactly. First, they revealed that one of their pain treatment candidates, a drug codenamed VX993, failed to meet its primary endpoint in a phase 2 clinical trial. That's a significant setback for a potential new revenue stream.
Okay, that's one blow. What was the other?
Additionally, they disclosed that the FDA, the Food and Drug Administration, does not currently see a clear path forward for achieving a broad label, meaning approval for wide use, for another pain drug they have called suzetrigine.
So two negative developments for future growth prospects in the pain area.
Correct. And these two pipeline disappointments completely overshadowed the strong performance of their current, profitable core business. It just demonstrates the market's extreme sensitivity to the future growth potential of biotechnology firms, where so much of the valuation is tied up in the hope and potential of drugs still in development.
A stark reminder that for biotech, the pipeline is everything.
It really is. Success and valuation are just inextricably linked to successful drug development and, crucially, regulatory approval down the line.
And just one more example, Twilio, TWLO, the communications platform company.
Twilio fell 18.52%. Again, not necessarily because Q2 was terrible, but because its Q3 profit guidance came in below what analysts were expecting. This suggested potential margin pressure ahead, even if current performance was okay.
So you see this clear, undeniable pattern emerging here across different sectors. The market is acting like a forward-looking beast, maybe more than ever, rewarding future promise and absolutely punishing any hint of future weakness, no matter how strong the past results might have been.
It's a powerful lesson, I think, in what's truly driving valuations in today's market environment. It's all about the narrative of tomorrow.
And that sets the stage perfectly for the week ahead, doesn't it? August 11th through August 15th. You called it a week of key inflection points.
I think it really is shaping up that way. The upcoming week is absolutely pivotal for economic data. We've got a whole slate of releases coming out that will directly address the market's most pressing questions right now.
Questions about inflation and the health of the consumer.
Exactly. Those are the two big ones. And these reports will be critical inputs for the Federal Reserve as they think about their policy decision at the September FOMC meeting.
So that comfortable narrative we talked about, manageable inflation, impending Fed rate cut, it's about to face a major reality check with this hard data.
Precisely. It creates the potential for a significant inflection point in market sentiment and direction, depending on what these numbers show.
Okay, what's the main event? What's the biggest report to watch?
The main event, the real economic crucible for the week, will be Tuesday's Consumer Price Index, the CPI report for the month of July.
And this one is particularly important because of the timing, right?
Yes. Crucially, this will be the first major inflation reading that captures the period after the administration's latest round of tariffs took effect. So it's not just another CPI report. It's a real test case for whether those tariffs are starting to translate into higher consumer prices.
What are the expectations for CPI?
The consensus forecast is for headline CPI to show a 2.8% year-over-year increase. That would be a slight uptick from 2.7% in the prior month. For core CPI, which excludes volatile food and energy prices, the expectation is 3.0% year-over-year, also a small tick up from 2.9% previously.
So analysts expect a slight increase. What happens if it comes in hotter than that?
Well, a hotter than expected print could seriously challenge that prevailing narrative of a dovish Fed that's ready to cut rates. It could really rattle markets, forcing them to reassess the likelihood and timing of rate cuts. This report, honestly, is probably the single most important catalyst for the entire week.
Okay, so all eyes on CPI Tuesday. What else is on the economic calendar?
Following that, on Thursday, we get the Producer Price Index, or PPI, for July. This gives us a look at inflation at the wholesale level.
And why is that important?
It provides clues about pipeline price pressures. If businesses are facing higher costs for the goods and services they buy, they might eventually pass those higher costs on to consumers. So PPI can sometimes foreshadow future moves in CPI.
What's the consensus for PPI?
The consensus forecast there is for a 0.2% month-over-month increase. That would be up from a flat reading, 0.0%, in the prior month. So again, expecting a slight pickup in price pressure.
And then on Friday, the focus shifts directly to the consumer.
Correctly. On Friday, we get the July retail sales report. This will offer a really direct look at the resilience of consumer spending, which, as you know, is the main engine of the U.S. economy.
What are expectations for retail sales? Still strong.
The consensus is for a 0.5% month-over-month increase. That's still solid growth, though it would be slightly down from the 0.6% increase we saw in the prior month. This report will tell us if consumers are continuing to spend despite higher prices and higher interest rates.
Anything else on the consumer front?
Yes, the week will also feature the preliminary reading of the University of Michigan Consumer Sentiment Survey for August. This gives us a very timely read on how households are feeling about the economy and, importantly, their expectations for inflation down the road.
And consumer expectations matter because
Because they can become a self-fulfilling prophecy, especially inflation expectations. If consumers expect prices to rise rapidly, they might change their spending behavior, potentially contributing to actual inflation. The sentiment reading also tells us about general confidence levels.
So a packed week for economic data. Get ready for some potential volatility around these releases, especially CPI on Tuesday.
Absolutely. These numbers will either validate the market's current optimism or potentially challenge it quite seriously.
Now, beyond the economic data, earnings season is mostly over, but there are still some important companies reporting this week, right?
That's right. While the majority of Q2 earnings season is behind us, several significant companies are scheduled to report, and they could offer valuable insights into key sectors of the economy, potentially moving markets.
Who's the biggest name to watch on the earnings front?
Probably the most anticipated report of the week comes on Wednesday after the market close, and that's Cisco Systems, CSCO.
Why is Cisco so important?
Cisco is widely seen as a bellwether for enterprise technology spending, particularly on networking infrastructure. Their results, and maybe more importantly, their commentary will be closely scrutinized for insights into a few key areas.
Like what?
Like the impact of tariffs on global supply chains and demand, the overall health of IT spending by businesses around the world, and the pace of ongoing digital transformation projects. Investors will be very keen to hear their outlook for capital expenditure from businesses.
What are the estimates for Cisco?
The consensus is expecting earnings per share of 0.98 cents on about $14.6 billion in revenue.
Okay, who else is reporting that could give us broader economic clues?
On Thursday, we get earnings from Deere & Co., DAE.
The tractor maker.
Exactly. Deere will provide a crucial reading on the health of the agricultural and construction sectors. Their earnings offer a glimpse into global farming trends, commodity prices affecting farmers, and infrastructure spending, which are often useful indicators of broader economic activity.
What's expected from Deere?
Consensus is looking for $4.58 in earnings per share.
Also on Thursday, we hear from some major Chinese tech companies.
Yes, results from Alibaba, VABA, and JD.com, JD, are due out on Thursday. These will be examined closely for any signs of a consumer rebound in China, which has been generally slower and more sluggish than many expected.
And also the impact of ongoing geopolitical tensions.
Always a key factor for these companies, yes. Their performance is often used as a proxy, rightly or wrongly, for the health of the broader Chinese economy and consumer.
And one more key report on Thursday related to the semiconductor theme.
Right. Applied Materials, AMAT, reports on Thursday. They're a major supplier of equipment used to manufacture semiconductors.
So their report is crucial given the new tariff landscape and the focus on domestic chip production.
Absolutely. Their commentary on capital expenditure plans from chip manufacturers, global factory utilization rates, and demand for advanced chip-making equipment will be a very significant focal point. Their results offer a critical insight into the supply side of the semiconductor industry, which is undergoing so much change right now.
What's the consensus for Applied Materials?
Analysts are expecting $2.36 in earnings per share.
Okay, so some really important earnings reports still to come. Finally, let's touch on the IPO pipeline. Are we seeing any new companies testing the waters?
We are. The market for initial public offerings, or IPOs, will see a few significant U.S. companies test investor appetite this week. This could indicate some renewed confidence in bringing new issues to market after a relatively quieter period for larger deals.
Who are the main ones expected?
The two largest deals anticipated are, first, a company called Bullish, trading under ticker BLSH. They're a technology company aiming to raise somewhere between $599 million and $724 million. They're slated to list on the New York Stock Exchange, NYSE.
When are they expected to price?
Expected pricing is around August 12th or 13th, so Tuesday or Wednesday. This will be an important test of investor demand for growth-oriented tech names in the current market environment.
And the other big one?
The other is Miami International Holdings, ticker MIAX. They're a financial exchange operator. They're targeting a deal size of $300 million to $362 million, also planning to list on the NYSE.
When is MIAX expected?
Expected pricing for them is around August 14th, so Thursday. Their performance will be a bit of a bellwether for investor appetite in the financial infrastructure sector.
And you mentioned IPO activity outside the U.S. as well.
Yes, it's worth noting that while we focus on the U.S. market, there's a separate and quite active IPO market continuing in India. Firms like Bluestone Jewelry and JSW Cement are currently in the process of offerings there, and a large future IPO from Tata Capital is also anticipated. It just highlights the very global landscape for new companies coming to market.
Okay, let's try to tie all of this together now. Thinking about last week's action and looking ahead to this pivotal week, what's the overall analyst's outlook? What are the key strategic considerations for you, the investor?
Well, I think the market enters this week with a generally cautious outlook. Maybe cautiously optimistic is fair. It's clearly buoyed by that strong technical momentum we saw, especially in the technology sector.
But facing significant event risk.
Exactly. Facing significant event risk from those key economic data releases we just covered, particularly the CPI report.
And that central tension we discussed remains the key issue.
It does. It remains unresolved. Can the powerful micro-level tailwinds, the strong corporate earnings from tech, the secular growth story around artificial intelligence, can they continue to overpower the macro-level headwinds?
Headwinds like the escalating tariffs, the broader geopolitical uncertainty, and this lingering threat of resurgent inflation.
Precisely. That is the fundamental question facing investors right now. And the answer, which we might start to get this week from the data, will likely dictate market direction in the near term.
And that issue of narrow market leadership, that remains a major vulnerability, doesn't it?
It absolutely does. The rally's heavy dependence on just a handful of mega-cap names means the overall market direction is highly sensitive to news affecting those specific companies. If one or two of them stumble, it can have an outsized impact.
The generals leading, the army lagging.
As we said earlier, yeah. While the generals of the market have advanced strongly, the broader army of stocks hasn't really kept pace. This creates a potentially fragile foundation for the recent gains.
It's like relying on just a few star players to win every single game. If they have an off night, the whole team struggles.
That's a great analogy for it. That concentration risk means that if those few mega caps do stumble, the broader market might not have enough underlying strength from other areas to pick up the slack, making the entire index potentially vulnerable to sharper corrections.
So given this environment, the momentum, the risks, the narrowness, the upcoming data, what are some key strategic points for you, the investor, to consider when navigating this current landscape?
Okay, a few things come to mind. First, valuations. Particularly in the growth category, and especially within technology, valuations are currently trading at a significant premium.
Compared to history, and compared to the rest of the market.
Both. They're high relative to historical averages, and they're trading at a large premium to the broader market, like the S&P 500 overall.
And what does that mean practically?
It means that while momentum is clearly powerful, we saw last week how punishing the reaction can be to even minor disappointments. Think the trade desk, think Fortinet. This suggests that finding new entry points in this hot space requires extreme selectivity. You really have to do your homework. And you need a high tolerance for financial volatility.
Because stocks priced for perfection can fall hard if they aren't perfect.
Exactly. Investors need to ask themselves, am I paying for the company's current strong performance, or am I paying mostly for future optimism that might already be overly baked into the price?
Now, this dynamic, these high valuations and growth, does that create opportunities elsewhere? Maybe a rotation into cheaper sectors?
It potentially could, yes. This dynamic may well create opportunities for investors looking for value to potentially rotate into more attractively valued sectors of the market.
You mentioned healthcare earlier as being undervalued.
Healthcare is one example. It remains statistically one of the most undervalued sectors. It's been weighed down for a while by policy uncertainty, concerns about drug pricing, rising costs.
So if the policy environment stabilizes,
A stabilization there could certainly lead to renewed investor interest in some of these relatively cheaper healthcare names. However, and this is a big however.
the Vertex example.
Exactly.
Yeah.
The sharp negative reaction to Vertex's pipeline news last week demonstrates that stock-specific risk remains acute, even within a sector that looks cheap overall. So, while a sector might appear undervalued on average, individual company risk, especially concerning their innovation pipelines or regulatory hurdles, is still very real and needs to be carefully evaluated. You can't just buy the sector blindly.
Good point. What about from a technical perspective? Are there key levels to watch on the charts?
Yes, from a technical standpoint, that S&P 500 intraday high from last Thursday, that 6,427 level where we saw the bearish engulfing candle form, that has now become a really critical level of overhead resistance.
So the market needs to break above that level to keep going up.
Essentially, yes. A failure to decisively break above 6,427 could confirm the bearish price action from that day. It could signal a potential near-term top has been put in place, possibly inviting a market pullback or at least a period of sideways consolidation.
So 6,427 on the S&P 500 is the key line in the sand for the bulls right now.
It's a very important level that market participants will be watching closely. It signals a key battleground between buyers trying to push higher and sellers trying to defend that level.
And speaking of critical levels and key events, let's circle back one last time to the CPI report on Tuesday. You said it's the single most important catalyst.
I really believe it is for this week. The outcome of Tuesday's CPI report stands as the single most important catalyst simply because of its direct implications for Fed policy expectations, which are underpinning so much of the market's current stance.
So what are the two potential scenarios, a cool report versus a hot report?
Right. A cool report, one that comes in line with or maybe even slightly below expectations, indicating that inflation remains contained despite those new tariffs. Well, that would validate the market's prevailing dovish Fed narrative.
And likely fuel the rally higher.
It could certainly provide fuel for the rally to continue, perhaps even pushing the S&P 500 decisively above that 6,427 resistance level.
Okay, that's the optimistic scenario. What about the pessimistic one, a hot report?
Conversely, a hot report, one that shows inflation accelerating or proving stickier than expected, that could be the pin that pricks the recent bubble of optimism.
Forcing a rethink on rate cuts.
Yes, forcing a rapid and potentially painful repricing of those rate cut probabilities we talked about, that 90% chance. And consequently, forcing a reevaluation of equity valuations, especially for those highly valued growth stocks that are most sensitive to interest rate expectations.
So investors really need to be prepared for heightened volatility around that CPI release on Tuesday.
Absolutely. It truly is the moment of truth for the market's current narrative this week. It's a week where the economic data could really define the market's direction and test the conviction behind this recent rally.
Okay, so we've peeled back the layers of last week's market action from the tech titans seemingly shrugging off tariffs, thanks in part to strategic moves like Apple's, to the stark reality of how quickly a stock can tumble if its future expectations falter, even slightly.
And now we find ourselves right on the cusp of a week where the economic data, particularly inflation, could genuinely define the market's near-term direction and challenge some of these deeply held assumptions about the Fed and the economy.
This deep dive really highlights that constant tension, doesn't it, between the big macro-level forces, tariffs, inflation, Fed policy, and the micro-level realities of corporate innovation, earnings growth, and strategic adaptation.
It absolutely does. And it's such a powerful reminder that the market is always, always forward-looking, often brutally so, as we saw last week. Understanding the nuance of future guidance, the story a company tells about tomorrow, seems just as crucial, if not more crucial, right now than understanding its past performance.
And what's fascinating is how strategic adaptation, like Apple's quick response to the tariff exemption, becomes a real competitive edge in this kind of environment. It's not just about having the best product anymore, it's about navigating the policy landscape effectively, too.
That's a huge point. Agility and strategic foresight in responding to these macro shifts are clearly being rewarded.
So here's a final thought for you, our listeners. Considering the market's laser focus right now on forward guidance and seeing how companies like Apple strategically adapt to major policy shifts, what if this isn't just a fleeting trend? What if this represents more permanent shift in how all businesses, and by extension, their stock valuations will be judged going forward?
It's an interesting question. Is resilience and adaptability becoming as important as pure growth?
Exactly. And how might you apply this lesson, this emphasis on looking forward, anticipating change, adapting strategically, not just reacting to past results in your own areas of interest, whether that's your career planning, managing your personal finances, or even trying to predict trends and navigate shifts in your own field or industry?
Something to definitely mull over.
Absolutely. Something to think about until our next deep dive.